Imagine receiving the phone call you have been working toward for the last 15 years. The corporate recruiter on the other line offers you a senior management position in a major Tier 1 city like New York or San Francisco. The offer includes a massive $50,000 bump in your annual base pay, moving your salary from $100,000 to $150,000. For most professionals, this feels like the definitive moment of arrival, a validation of your career capital, and an obvious green light to pack your bags and upgrade your lifestyle. Conventional wisdom says that an extra $50,000 a year is a transformative sum of money that automatically accelerates your timeline to financial independence. It is the kind of raise that should allow you to maximize your retirement accounts, buy a nicer home, and secure your family's future. But if you look past the raw face value number and apply actual mathematical modeling to this transition, you discover a deeply troubling paradox. Under our current economic framework, accepting a $50,000 promotion that requires relocating to a high cost of living area frequently leaves middle-class professionals with less disposable income and a slower wealth accumulation trajectory than they had at their original, lower salary. The real math shows that what looks like a massive step forward on a resume can easily become a structural trap that delays your retirement by a decade. To understand how a massive pay raise can leave you poorer, we have to establish a standardized baseline using verified data from the IRS and the Bureau of Labor Statistics. For this analysis, we are evaluating a 40-year-old married professional moving from a medium-sized, medium cost of living city to a Tier 1 metro area. Our baseline assumes a standard inflation rate of 3%, which aligns with long-term historical averages recorded by the CPI. We will apply the 2026 federal progressive tax brackets for a married couple filing jointly, where the standard deduction sits at $27,400. In your original location, we assume an average state income tax rate of 4% and a baseline cost of living that matches the national average. When we calculate these fixed variables, it becomes clear that navigating the modern corporate landscape is not a simple game of earning more money. It is a complex math problem where your primary adversaries are systemic tax drag, housing inflation, and lifestyle creep under the guise of professional necessity. If you do not calculate these forces before signing an employment contract, you are effectively flying blind. The stagnant nature of middle-class wealth over the last decade is not your fault. The system is optimized to reclaim your marginal earnings before they ever hit your investment account. But once you understand the exact mechanics of how this money is extracted, you can stop making career moves based on vanity metrics and start making them based on net purchasing power. Before we tear down the numbers, let us look at why this choice feels so incredibly right. When you are offered a $50,000 raise, your brain immediately engages in mental accounting. This is a behavioral psychology term where individuals categorize and value funds differently based on where they come from, rather than treating every dollar as identical. You look at that $50,000 as a clean, isolated block of capital. In your mind, you run a simple calculation. $50,000 divided by 12 months equals an extra $4,166 per month. You start thinking about how that extra cash can change your daily life. It means you can easily max out your workplace 401k plan, which has an IRS contribution limit of $23,000. Doing so reduces your taxable income while building a massive nest egg. It means you can comfortably afford the $4,000 monthly mortgage payment on a beautiful 4-bedroom home in a top-tier school district. It means you can finally upgrade your reliable but aging sedan to a luxury SUV without feeling a hint of financial guilt. Every piece of social conditioning you have received tells you that moving into a higher bracket is the ultimate goal. Your peers congratulate you, your family is proud, and your LinkedIn profile looks more impressive. The conventional financial path states that maximizing your gross income is the single most effective lever for building wealth. And on paper, a 50% increase in your base salary seems like an absolute mathematical home run that no rational person would ever turn down. But when you run the actual numbers through a cold, unforgiving spreadsheet, the illusion of that $50,000 raise completely evaporates. The real math shows that gross income is a vanity metric. Net purchasing power is the only number that dictates your financial destiny. Let's peel back the hidden costs layer by layer, starting with the immediate impact of federal and state progressive taxation. When you earn $100,000 as a married couple filing jointly, your top marginal federal tax rate is 12%. The moment your salary jumps to $150,000, every single dollar of that $50,000 raise is pushed directly into the 22% federal tax bracket. This means the federal government instantly claims $11,000 of your raise before you ever see a dime. Furthermore, relocating to a Tier 1 metro area usually means moving from a low-tax state to a high-tax state. If your state income tax rate climbs from 4% to 9%, your total state tax liability jumps from $4,000 to $13,500. When you combine the higher federal marginal tax bracket with the increased state tax burden, your $50,000 raise is instantly slashed by $20,500.
Your net take-home raise is no longer $4,166 per month, it is just $2,458 per month. Now let us look at the second layer, housing cost drag. In a medium cost of living market, a comfortable 3-bedroom home or a premium apartment might cost you $2,500 a month. In a Tier 1 metro area, housing market dynamics are vastly different. To maintain a comparable standard of living in a safe neighborhood with good schools, rent or mortgage costs routinely double. According to data from the BLS, housing costs in premium metropolitan areas are consistently 60 to 80% higher than the national average. If your monthly housing cost rises from $2,500 to $4,500, that move alone consumes an additional $2,000 every single month. Deducting that from your net take-home raise leaves you with just $458 of actual new monthly cash flow. The third layer is localized inflation on everyday goods and services, paired with professional lifestyle inflation. In a major metropolitan hub, everything from groceries and gas to car insurance and childcare carries a premium. Regional price parities indicate that general goods and services in Tier 1 cities cost roughly 25% more than the national baseline. If your baseline household spending was $3,000 a month in your old city, it will now cost you $3,750 a month just to consume the exact same basket of goods. This $750 increase completely wipes out your remaining $458 of net cash flow, putting you into a structural monthly deficit of $292. You are now working a higher stress job, carrying immense professional responsibility, and managing a larger team, yet you have less real purchasing power at the end of every month than you did when you made $100,000. To see the devastating long-term consequences of this financial trap, we must simulate this decision across a 20-year career horizon using historical market returns. Let us look at two distinct paths. Professional A rejects the high salary trap, stays in the medium cost of living market making $100,000, and aggressively optimizes their lower cost of living to invest $1,500 a month into a low-cost S&P 500 index fund. Professional B accepts the $50,000 raise, moves to the Tier 1 city making $150,000, but finds their cash flow completely choked by taxes, housing, and localized inflation, leaving them with zero additional dollars to invest. We will assume a standard nominal market rate of 10%, which reduces to a 7% real inflation-adjusted return based on a century of Federal Reserve and stock market data. Let us look at the checkpoint at year 5. Professional A, living comfortably in the lower-cost market, has consistently compounded their $1,500 a month. In just 5 years, their investment account has grown to an inflation-adjusted balance of $106,800. Meanwhile, Professional B has spent 5 years managing a massive corporate budget, working longer hours and dealing with intense metropolitan traffic. Because their higher salary was entirely consumed by the structural costs of their new city, their investment contributions did not increase. Their portfolio balance sits exactly where it started 5 years ago. Professional B is experiencing severe lifestyle inflation, a psychological phenomenon where an individual's discretionary consumption increases hand-in-hand with their income. They feel wealthy because of their job title and their zip code, but their balance sheet is completely stagnant. Let's advance the simulation to year 10. Professional A's portfolio has now crossed a major critical mass threshold. Through the unstoppable power of compound interest, their index fund balance has swelled to $257,000. This capital is now generating significant returns independent of their labor. Professional B, now 45 years old, is trapped on a high-income hedonic treadmill. They cannot downsize because their professional network and social circle demand a certain level of appearance, and their high fixed costs mean they are living paycheck to paycheck on $150,000 a year. They are entirely dependent on their monthly salary just to keep their head above water. Finally, let us look at the checkpoint at year 20, when both professionals reach age 60. Professional A's steady, disciplined investment has compounded into an incredible inflation-adjusted total of $780,000. Following the safe withdrawal rate framework established by the Trinity study, this nest egg can safely provide them with over $31,000 a year of inflation-adjusted income in perpetuity, allowing them to transition into early retirement with absolute peace of mind. What about Professional B? After 20 years of elite corporate service and generating millions of dollars in value for their employer, their personal net worth is shockingly low. They have no meaningful investment portfolio outside of a nominal workplace match. Their high fixed costs remain permanently locked in, and they are forced to keep working well past age 65 simply because they cannot afford the massive drop in income that retirement would bring. The small, logical decision to accept a $50,000 career advancement 20 years ago completely altered their life trajectory, stripping them of their financial freedom. This is not personalized financial advice. Consult a certified financial advisor for your specific situation. To maintain complete intellectual honesty, we must acknowledge that there are specific, distinct scenarios where accepting that $50,000 raise and moving to a Tier 1 city is the mathematically correct choice. The first scenario is when the move is treated strictly as a temporary career launchpad rather than a permanent lifestyle choice. If you relocate to a major corporate hub for 3 to 5 years, intentionally live far below your means by renting a modest apartment, and use that time to secure subsequent promotions that push your salary from $150,000 to $300,000, the math completely changes. At that level of compensation, you successfully outrun the fixed baseline costs of the high cost of living area, allowing your savings rate to explode. The second scenario is for young, single professionals who do not have the fixed expenses of a family, childcare, or large housing requirements, allowing them to bypass the massive cost penalties that hit a married professional with children. The higher-level financial principle at play here transcends this specific career choice. Wealth is not determined by how much money you gross. It is determined by the spread you can consistently maintain between your income and your structural cost of living. True financial freedom is built in the margins. If you blindly chase nominal salary figures without mapping out progressive tax drag, geographic housing inflation, and the psychological traps of lifestyle inflation, you are simply running faster on a treadmill that is spinning against you. Before you accept your next promotion, run the numbers through the lens of net purchasing power, protect your investment spread, and remember that an impressive job title will never replace the security of a compounding balance sheet.